So the other day I was watching Shark Tank with my kids and I realized they do not fully understand why those startups are raising money. Later I was discussing with them about stock market and I realized it's the same concept that they are not getting on why big companies like Google, Microsoft, Amazon, why these big giant companies need to raise money and how does that play a role in stock market. Now, even when I started investing in stocks, even I did not fully understand most of this funding part. And it took quite some time for me to figure this all out to understand what are angel investors, what is Series A, Series B, seed funding, IPO, private funding, public funding. So, if you are in the same boat, watch this video to the end and I will explain this whole concept step by step. All right. Note that it is a fundamental thing to understand how the cash flow, money flow works on a company before I can explain how the stock market works. So I have put this on the screen to explain, taking this example of a very small business and try to see how the money flow from one end to the other end. So if we look at the very left, we can see that we have customers who are paying for certain services or certain product. Now this company will take the payment from them. That's the money coming in. And then that money will be used to deliver product services back to those customers. And then the money that is being made will be used for rents. It will be used to pay taxes. It will be used to pay wages. And some of it might be saving that the company will have. So that's a very typical cash flow. Same thing that a business is doing. It is applied for individuals as well. Individuals make money. They use that money to pay rent, to pay taxes, and bunch of other things that they do, and they make some savings. So company more or less follow the same exact process. Now taking it one step further, and having a different view of the same concept. So here is a paying customer who is giving some money to the business for certain products or services that they need. Now, once the company has that money, it can do two things with that money that is made. And I think a better way to understand it is to use an example. So let's say this is a business which is in business of making cookies. So they are making cookies. This customer is paying money for their cookies. Let's say they made $100 worth of cookies. The customer came in, they paid $100, and let's say the cost to make those cookies were $10. So the company is making almost 9 times the profit. So now that remaining profit, they can do two things with it. They can take that $90, they can go and have a party and spend everything, which is in stock world you will see is the company is paying shareholders. That shareholder could be one shareholder or it could be multiple shareholders. So regardless of it, if that money is paid in stock terms, you will see this is known as dividends. Dividends are paid. But for most of the startups, if they do that, then all the money is lost. The business is back to zero. So typically startups won't do that. What they would do is they will take that profit, $90, they will reinvest back in the business so that the business grows. So when the business started, it started as a $10 business with an investment of $10. Now it is worth $100. So they will invest all $100, they will make more cookies. And now these $100, they might be able to send for thousands of dollars, right? So now the company is 10 times bigger. And this is a hypothetical example. In real world, the margins are not that high. And also there are other costs associated. As the business grows, the company needs to hire probably more people. Let's say if it takes one day to make cookies of worth $10, it might take 10 days to make cookies worth $400. So they have to hire more people. So there are other costs. They might need to do some marketing to get customers because the customers will not come from anywhere. And so giving a simplified example here just to make a point. But the point that I'm trying to make over here is that money that is coming in, either it can be returned to the shareholder or it can be reinvested back in the company. If it is reinvested back in the company, then the company can grow on its own. And most important, it does not need any funding. Typically, any startup, when it begins, for a couple of cycles, it follows this cycle. It will just keep making money, keep growing on their own. And then at some point of time, the company will start growing much faster pace that it needs additional money. Otherwise, there could be other competitors who are coming as well. If the company is not going far enough, somebody else will take over the business and they will beat this company as well. So let me to explain this further. The startups typically follow this pattern where the startup funding, they start with an idea stage. They in that idea stage, only the startup founder might be there. Only one person might be there who have an idea, or maybe two-person who came up with one idea. So typically it's $0 investment and lot of work. They might be spending nights, days, and they might have their own day jobs. They might be studying in school or college. So this is a side hustle for them. So that's the founder stage or co-founder stage with $0 investment. They are able to start something. Now, as the money starts growing, taking the example of cookie business, if there are more and more customers coming, then they need some investment, maybe a couple of $1,000, $1,000, $2,000, $15,000. So in this stage, they can approach their family and friends, and for the most part, those family and friends at this point can invest because few $1,000s is people have in their savings. So they will take out from their savings. They trust these people. So they will say, okay, I trust you. I will invest in your business. And they can do this in one of two ways. They can loan the money to the person and say, okay, once your business grows bigger, you can pay it back. Or they can ask for ownership that, okay, I will invest in your company, but can you make me 10%, 20%, 50% owner of the company? And at this stage, they have nothing to lose. The founders have nothing to lose because if they don't get that money, the business will die anyways. So they would be okay giving up part of the ownership as well. So that's the first stage, family and friends. Now let's assume that business keeps growing bigger and bigger and becomes $200,000 worth of business. Now at this point, the family and friends won't have this much saving in the bank account. So the founders need to go to bigger investors. Sometimes they are known as angel investors, or they have other bunch of different categories. But this round is basically seed round. Seed, if you can think about it, this is like a small plant that is being, it's just at a seed phase. It doesn't really need millions of dollars worth of investment right now, but it has potential to become a big tree. So at seed round, typically angel investors will spend a couple of $100,000. This is the part where Shark Tank, if you have watched, is where those founders come in, where they have already done the initial work. They have grown the company up to a couple of $100,000, and sometimes they will come that I want to offer my company 10% ownership for an investment of $100,000, which means they have already grown the business to $1 million, and they are asking for investment of 100,000 for 10%. So this is the seed round phase. After this company grows a little bit more, it is a couple of $1 million. So even these angel investors do not have that much free money sitting where they can take risk with that money, because this is a high risk business. That all money might not be, it might just get wasted if the startup doesn't really work, if the startup gets bankrupt. So they might lose. So it's a high risk, high reward business. So up to a certain point, these angel investors will be fine investing, but after that point, they would not really be comfortable. So at that point, the founders needs to go and approach bigger companies who are known as VCs, venture capitals. So those venture capital firms are in this business. Their whole business is to evaluate these startups and see which has potential to grow even bigger. And if they see a potential, they will be happy to invest a couple of $1 million in those companies. These are known as Series A, Series B, Series C. At this point of time, the company is already pretty well known. However, another thing to note, this stage is known as private funding. Why it is private funding? Because apart from these investors and founders, nobody else knows about the financials of the company. Nobody else apart from these know how much money that company is making, how much money they are spending, and which part they are spending. All of that is private information. And this all works fine up to a couple of $1 million worth of stage. Now let's assume this company really got even big, something like Amazon, Google, Microsoft. When they were in their early stage, at some point they needed a couple of $100 million worth of investment. So that is beyond even these VCs. Even they cannot invest this much money. So what they will do is they will go to the general public. general, and if it is the company is operating in US, they will go to US public. If it is operating in India or China, they will go to India or China public. They will ask everybody to invest in that company, and that's known as showing shares or stocks of the company. So let's say they take 10% of the company. Let's assume it's $1 billion company. 10% of $1 billion is $100 million. So they will issue stocks worth of $100 million. If every stock, let's say, cost $10, so that means they will issue 10 million stocks. And this whole process is known as IPO, initial public offering. One thing I missed to mention, at every stage when the company is being formed, that needs to be registered with government. And every year the company needs to still report certain things to government, although it's a private company, but they have to file taxes with government and they have to keep reporting things. And when they at an IPO stage, there is a Security and Exchange Commission, SEC. They need to file with them that it's a good company, they are making a lot of money, they have potential to grow more. That's why they're asking for an IPO, or that's why they're issuing stocks, and the government will review and they will approve the initial public offering. And at that stage, the company will be listed on a stock exchange. In a later video, I will cover there are many stock exchange. So, for example, in US, New York Stock Exchange, NYSE is one of the most popular stock exchange. So once it is listed, then it is known as a public company. So if you think about Amazon, we think about Google, we think about Microsoft, they all started similarly. Apple started from a garage. Amazon started from a garage. For Amazon, it was Jeff Bezos who was initially starting the company. And then his close family and friends were supporting him initially. And then he got more people to invest on Amazon at a couple of 100,000 valuation. Then it became a couple of $1 million valuation. Then there was most funding that was provided. And later, Amazon filed for IPO and became public. Apple went through Steve Jobs, Wozniak. They went through the same thing. Microsoft went through the same thing with Bill Gates and other founders. And I will probably cover some of those big companies' journey as well, how their funding journey and how their overall journey was. But at least this video gave a high-level overview on how this whole funding works and how really a company has gone through public. So thanks a lot for watching the video. I'm hoping this was helpful and useful for you. If yes, please remember to subscribe to this channel, because I'll be making more video like this, and hopefully it will help you to gain an understanding on these areas. I'll see you next time.